Index is still under pressure this morning. We've got some selling. We'll leave that to the side for a moment, though, and talk some stocks. As there have been outperformers, the list has been getting thin. Let's talk with John Barr, portfolio manager at the Needham Aggressive Growth Fund, for some overlooked companies, dare I say, John, on your list this morning. Thank you for being here, number one. Number two, tell me about how you pick stocks before we dive into these specifically, as we're seeing broad market investing come under some scrutiny here. What's the process you use to find companies that can win in this environment?
Oliver, I look to find companies that I call hidden compounders and then hold them through a transition period, and then hold them through a period where the results are showing through and broader investor class can see them, and I call those quality compounders. So the portfolio in the Needham Aggressive Growth Fund consists of all three of those categories of companies. It's hidden compounders, transitionary companies, and quality compounders. And my average turnover is about 10%, so really look to hold these investments for a long time.
So compounding being the important thread between these. And as far as characteristics go, is it as simple as defining characteristics you want, certain valuation ratios or cash flow dynamics, something in the CFA books and running a screen to pick them out? Or do you really have to right now find companies with almost abnormalities that you can capitalize, like Microsoft just did, saying here's a stock that has been through an abnormal news flow process, let's buy it on a discount?
Well, so there's an overlay, which are certain industry trends, and examples of those right now: data centers are going through very strong growth. Secondly, there's a lot going on with engineering and advanced manufacturing. And third, I like companies that combine data analytics and doing real things like logistics. So those are three industry trends. And then the types of companies that I'm looking for when they're a hidden compounder, I like to look for companies that can be 5 to 10 times their current size, that have great management. And to me, that means founders, family, or long tenured, because they tend to think longer term. And third would be the third attribute are companies that have been going through an investment period, that the results are just not showing through, so the screens won't find them.
One of the stocks you like right now is SMCI, Super Micro Computing, and pretty interesting business, $2 billion market cap right now. Stock looks very solid as other businesses connected to cloud or data centers have been selling hard the last couple months. This one's held its ground. Can that continue? Can this business grow if peers in its group are under pressure in the market?
Supermicro I classify as a quality compounder. It's a 12-year holding of the fund. We bought it when it was a micro cap. As you pointed out, they make servers and storage that sells into data centers and enterprises, run by the CEO founder 30 years ago. We think it can be 5 to 10 times its current size. And the results show through. I mean, they show strong return on capital. They're showing 10 to 15% revenue growth. But to your point, the protection on the downside comes from they're going to earn about $4 a share this year. And with the stock at 45 or so, that's 11 times earnings. So with good, strong top line growth and continued margin expansion, and if the company can be 5 times its current size in a number of years, it's our kind of long-term holding.
Okay, Supermicro Computer has been a great trade here over the last couple of years, looking strong still. Another one that's on your mind this morning, PDFS is the ticker. Supermicro I've heard of. This one's a little bit new, PDF Solutions, but still connected into tech. What is this business?
So PDF Solutions is the data analytics cloud for semiconductor design and manufacturing. So it's about $1 billion market cap. The company is in that transitionary period that I described earlier, And they've been investing for 5 years in this new service area, and run by the founder 30 years ago. He owns about 7% of the company, co-founder, I should say. And we think this company can be 5 to 10 times its current $100 million in revenue. It's had investments or losses for the last 5 years. This year should be very close to break even, and then profitability should show through as the high margin new business grows and the old legacy business tails off. So It's a business model transition.
All right, PDF solutions, not PDF documents, still high-tech stuff. John, thanks for the stock picks. We're going to trade them now. Maybe not quite as long-term as you, but we're going to trade them bullish. John Barr joining us from the Needham Aggressive Growth Fund. Looking forward to more picks in the future from John. Let's bring in Tom. All right, so Tom, a little bit of overlooked stocks here. Let's talk PDFS first. You still have options you can trade in here, so what'd you see?
Yeah, Oliver, they don't have weekly options, and you're right. These are some overlooked stocks that we typically don't hit on in this segment.
Only about 5 expiries for this right now.
Yeah, PDFS just pulled back. It's down about 10% from its all-time highs, above $33 a share. So how do you take advantage of this using the option market? There are no weeklies. So I looked at a simple stock replacement. Doesn't pay a dividend, so you don't have to worry about that. Where I'm just going to buy a deeper in the money call, but give myself some duration, give myself some time. So I went out to the May 25 strike call, which is currently in the money, so it's got a higher delta. It reacts more like the stock. If you pay a debit of about $4.80, that's your risk on this, $480 per call that you buy that's in the money. Your break even at $29.80 over the next 122 days to the upside here. So you need a few bucks to get above that break even, but you're giving yourself duration. You'll capture an earnings event in there also. But if it gets back to those levels above that $33 all-time high, that's what you're looking for on a trade like this. So as opposed to maybe buying the shares, a lower capital input cost on a trade like this, using the option market over a specific time frame might be the way to go with defining your risk on that and the lower cost entry point.
All right. Okay, so buying the calls here, giving yourself some time, a couple months, not the a 12-year holding duration perhaps, but you don't have that in the options chain right now. But the stock's looking pretty darn good, got to admit, even with the market coming under pressure. SMCI looks even better. Super Micro is a rock right now. We do have earnings in a couple weeks. We'll see how it fares then. Last time was a big gap up. So do you want to hedge that event a little bit? Because I noticed you're doing a slightly less bullish trade on this one.
Yeah, a different way to take, using the option market to take that bullish sentiment stance here. It's pulled back from those all-time highs just under 48. So I wanted to give myself a little bit of room while still taking that bullish sentiment. Just going out to that February monthly cycle, so about 31 days till expiration, where I'm going to sell an out-of-the-money put. And now it's pretty aggressive out of the money put. It's just below the current share price in SMCI, we'll get that right.
There you go.
The 45 strike put. You can sell one of those for about a $2.50 credit. Now, both of these stocks, Oliver, I think this is a key thing to point out to investors and viewers here, is the fact that they're really illiquid. They've got wide bid-ask spreads. They don't trade a lot on the option market. So always go in maybe above where you think you can sell something or below where you think you can buy something because the markets are so wide. But in this example, selling the Feb 45 strike put for $2.50 credit takes my break even on this where I'll start losing money down to $42.50. So I've given myself a nice cushion to the downside over the next month for this stock to continue to trade above that 45 strike. Now, this is one of those repetitive type strategies where I can do it over and over again on a month-to-month basis if I believe that this stock is going to stay above a specific strike that I sell. And remember to use the bid-ask spreads on some of these when you're selling puts, maybe to the higher end. Maybe you go up to $3 or $3.50 to start out with. You can cancel, replace. But this might be a way to play this for upside, but you're giving yourself a cushion to the downside.
Okay. All right. So selling downside in Super Micro and buying upside in PDFS. Thanks, Tom White, for the trades. Good work. Yeah. Hour 2.